Accounting, a practice dating back thousands of years, is essential for tracking financial transactions. It provides a systematic way to record, report, and analyze financial data. The double entry system, developed in the 15th century, revolutionized accounting by ensuring every transaction affects two accounts. This system is based on three fundamental types of accounts: personal account, real account, and nominal account. Let's break them down step by step with real-world examples. First, we have asset accounts. Imagine a business owner checking their inventory. This represents the company's resources. Next, liability accounts. Think of an employee receiving a paycheck. This is money the company owes. Finally, equity accounts. Picture a business meeting discussing profits. This is the owner's claim after liabilities. Personal accounts. These accounts deal with individuals, firms, or organizations. Examples include accounts of customers, suppliers, and employees. The golden rule is, debit the receiver, credit the giver. For instance, when a customer pays, you credit their account. When you pay a supplier, you debit their account. Real accounts. These accounts deal with tangible and intangible assets, essentially the things we own. Examples include buildings, machinery, patents, and trademarks. The golden rule is, debit what comes in, credit what goes out. For instance, when a company purchases new equipment, the equipment account is debited, and the cash or bank account is credited. Similarly, when a company sells a piece of machinery, the machinery account is credited, and the cash or bank account is debited. Alright, now let's dive into nominal accounts. These accounts deal with expenses, losses, incomes, and gains. The golden rule for nominal accounts is, debit all expenses and losses and credit all incomes and gains. For example, when a company pays rent, it records this as an expense. Similarly, when it earns interest, it records this as income. Nominal accounts help in determining the net profit or loss of a business by summarizing all incomes and expenses at the end of an accounting period. Let's summarize the golden rules for different types of accounts in detail. For personal accounts, the rule is, debit the receiver, credit the giver. For example, a loan taken from a bank or a payment to a supplier. Another example is when you receive money from a friend, you debit your account and credit your friend's account. For real accounts, the rule is, debit what comes in, credit what goes out. Think of buying machinery or selling land. Additionally, when you purchase office supplies, you debit the supplies account and credit the cash account. And for nominal accounts, the rule is, debit all expenses and losses, credit all incomes and gains. Examples include salary paid or rent received. Another example is when you incur a utility expense, you debit the utility expense account and credit the cash account. Now let's dive into a detailed practical case study. Imagine you start a business and invest 1 lakh rupees in cash. This is your initial capital. You rent an office for 20,000 rupees and buy machinery worth 50,000 rupees. Let's record these transactions step by step. First, debit the cash account and credit the owner's equity account for the initial investment. Next, debit the rent expense account and credit the cash account for the office rent. Finally, debit the machinery account and credit the cash account for the machinery purchase. This way you can systematically record and track all your business transactions. To wrap things up, let's delve into a detailed conceptual takeaway. Personal accounts are crucial as they deal with people and entities, helping us track transactions with customers, suppliers, and other stakeholders. Real accounts focus on assets and things we own, providing a clear picture of the company's resources and investments. Nominal accounts manage the money flow, such as expenses and incomes, which are essential for understanding profitability and financial health. Mastering these account types is fundamental for accurate financial reporting and effective decision-making in any business.